So the next section we're going to talk about is financial basics. Starting with financial basics, I think back to a lot of my customers over the several years I've been in business have told me that accounting was not their forte in college. They were lucky to pass accounting, in fact, which is great because they're in a business to sell products and services that are not accounting related, but doesn't mean that they can just wave off not knowing anything about accounting. Some of the best business owners that I have understand enough to know, not enough to be dangerous, but enough to know really the back end of their business and really be able to control that. Let's start with some terminology basics. First, every transaction in and out of your company affects two accounts in your accounting system. It's called double entry accounting, and it affects two different account sheets. Now, when we talk about account sheets, we're talking more of paper accounting, which you don't want to really get into, in my opinion. There's just too many great, inexpensive software out there to manage that for you. But if you were doing it on paper, it would affect two different account sheets. One would be a debit and one would be a credit, which goes into the debits and credits. We'll talk a little bit more about how you determine debits and credits in a nice little formula. But in this case, debits and credits, if you think about an asset and an expense, they're your debit. And liability and income have your credit. You also have cash versus accrual accounting. Now we'll talk about standard cash and standard accrual. For standard cash basis, the business gets credit for the expense when they actually incur the expense and the income when they actually receive the money in from the customer. Whereas in accrual-based accounting, they actually get credit for a bill once it's incurred and an invoice to a customer once they invoice the customer. Typically, on a cash-based company, I would say most of our businesses are cash-based. Probably about 95 to 97% of our customers are on a cash-based accounting. Very few are on an accrual. With the accrual, unless you always have expenses that exceed your accounts payable that exceed your accounts receivable, you typically are not going to be on an accrual basis. Accrual-based accounting can be a little bit more complex to manage as well. On a cash-based accounting, you can also have a non-standard cash-based, which is more of a kind of a cross between the two, where you have, let's say, a construction company. We have a lot of construction companies that we do accounting for, that they might be on a modified cash, where at the end of the year, we take into consideration all of their jobs that are currently open that didn't close in that year, and we then roll them into a more like a work in process account in our balance sheet, so that way you're not actually getting all the credit for the expenses and income in that year. So you can have a mixture, and if you're in that scenario where you are a building firm and it's not so cut and dry, those are definitely things that you can talk to your CPA about. Next, let's look at the chart of accounts. There's two different reports that you pull from the chart of accounts. One is going to be a balance sheet, and one is going to be a profit and loss. On the balance sheet, we have three different main categories. The first one is assets, which start with a number 1. Not all businesses use account number system, but if you do, you want to make sure that you follow the standard guidelines. So assets usually start with a 1. For example, in your accounting, your bank account is usually your first, or your cash accounts, I should say, are normally your first accounts showing in your balance sheet. And typically, your primary bank account starts with a 100 or 1,000. So it depends on, again, if you're using the account numbers or not. The next one is a liability, which starts as a 2. And the 2, again, the balance sheet account. So you have your 2. And then you have your equity, which is 3. I'll go into more about what specifically those are in a later slide. Next, we have our profit and loss, which is also called an income statement. We have our income, which starts as a 4. And then we have our cost of goods sold, but not every company is going to have a cost of goods sold. But it doesn't mean your expenses should start with a 5. Keep in mind you should have the standard theory of how you're setting up your account numbering system, again, if you use it. Now, let me explain a little bit about the cost of goods sold. Typically, in a service business, you don't really have a lot of cost of goods sold. For straight service, you have income and you have expenses. But there are companies like retail establishments, product-type companies, construction-type companies, where they have a certain cost that's associated with earning that revenue. But for the fact of them having that expense, they could not earn that revenue. Let's take a retail store as an example. Let's say the retail wholesale buys a widget for $50. They sell it for $100. Well, if you're looking at the income statement, you have $100 for income, minus the $50 for your cost of goods sold, leaving you a gross profit of $50. If you take a construction company, to build a house, for example, a house might be, let's say, $500,000 house, but it might take $200,000 in materials, $100 or $100,000, excuse me, $100,000 in labor, and then it leaves you a gross profit of $200,000. So you have to keep in mind what is your business and if you're going to have those types of cost of goods sold. Next, we have an expense. All businesses have expenses, and those typically start with a 6. We have two remaining categories. One is other income and one is other expenses. Both of these are to be used for other income and expenses that are not related to the standard running of your business. Income, other income as an example, unless you're an institution that provides financing and part of your revenue of being in business is collecting interest. Let's say you have just an interest-bearing checking account, kind of rare, but they still exist. That would be the interest that you earn on the interest-bearing checking account would be other income. Likewise, another expense might be an example of maybe you had an asset that you sold and you lost money on that asset. Then another expense account might be loss of a sale of an asset. That would be considered another expense. So they're more rarely used than commonly used, and just keep in mind those different types of scenarios. Let's look further into the assets. So in an asset account, we have the property or item as valued that a business owner is calling an asset includes cash. You have inventory. Again, inventory is most likely products that you're reselling. It could be raw goods. If you're a manufacturing company, it could also be raw goods. You have office buildings, land, and then you have different categories of assets. So let's break that down even further. We have other current assets, which can be prepaids. Usually, a cash-based company does not have prepaids. Usually, prepaids are more of an insurance-type prepaid. Example would be a company on an accrual basis paying for their health insurance for their employees. Usually, those are prepaid a month in advance. Sometimes workers' compensation is prepaid, and liability insurance, which we'll get into in a later chapter. Next, we have other assets, which are utility deposits. You can also have rent deposits. If you're a business and you have either rented or you own a business location where you have power, chances are you do have a utility deposit. If you're renting, chances are you do have prepaid rent. Whether it's a deposit and last month's or a combination of both, those all should be recorded in your balance sheet because that's money that's going to either be used as future rent or it's going to be returned to you once you leave that place. Next, we have fixed assets. Now, what's also important about fixed assets is until you dispose of or sell those fixed assets, they stay as a fixed asset, the same dollar amount on your balance sheet. You have vehicles, computers, and you have accumulated depreciation. Now, accumulated depreciation is what takes your fixed asset value and expenses the value over time. The accumulated depreciation is the only negative you should ever see in your balance sheet. Of course, sometimes there are negatives if you've overdrawn in your retained earnings or your equity, then those can be negative. But as far as an asset, that's the only negative you should ever see on your balance sheet. Next, let's take a look at the liabilities. Some examples are accounts payable, your mortgage payable, and your credit card payable. I'm going to pause on the credit card payable and talk a little bit about that. It's important that if you carry balances on your credit card month to month, that they are included on your balance sheet. I have a customer that we did a large cleanup job for them last week because in 2011, they had almost $100,000 in credit card expenses that their CPA never accounted for on their tax return because they didn't have it in their accounting system right. So we were able to redo their taxes and they were able to get credit for that. But in the meantime, they had to pay more taxes on that almost $100,000 in the year that they didn't have that expense claimed for. So it's really important that that anything you owe money on, that appears on your balance sheet. Next is taxes payable, and the taxes payable can be both payroll and sales tax. Now we have different general categories of liabilities. We have long-term liabilities, which can be, let's say you have a vehicle loan that's over 1 year, it's over 12 months, maybe you have a 5-year loan. That is a long-term liability. And then you have other current liabilities, which are less than 12 months. If you don't know, let's say you have a loan that you hope to pay off in 1 year, but you don't know if you will, you can set it up as a long-term liability, and then you can always pay it off early. Next, we have equity accounts. In equity accounts, we have the retained earnings, which is going to be something that you see after your first year of being in business. The cumulative prior year's net income is what is included in the retained earnings. So you have a loss in 1 year and a profit in another year. The retained earnings is going to be the net between the two. That's a roll forward number, just like everything else in your balance sheet. Your balance sheet continues to live year after year after year. You have capital stock. Capital stock is tied to the amount of shares owned by the owner or owners, and it usually gives a value, usually your first return or your first years when you establish that. So you have your corporate set of books where you have shares. Maybe you have 100 shares at $1, or you have 100 shares at $10. That's usually determined that, and I rarely see that change in smaller businesses. You also have, considering we're talking about maybe more like an S corporation, you have shareholder equity, and it's money that's either invested or distributed between the owners themselves. Now, also keep in mind that your shareholder equity is the account that you use, whether you're investing money in, unless you specifically have written out a notes payable from the company back to you for that amount. Typically, you'll see that more in a partnership type agreement where you're not the only one that can put in money. But if you're the only person in an S corporation, then typically that money just flows in and out of your equity account. But also, you have to keep in mind that if you're not paying back a loan that was set up in your accounting, and if it's not taxed payroll that flows through as an expense, then it goes through as your distribution. So just keep that in mind in an equity. Next couple of slides are really going to go over the raw basic accounting, which is T accounts. And if you talk to an accounting professional, they'll talk to you about a T account. Your debit's always going to be on your left side, and your credit's always going to be on your right side. This next slide, this looks like a T account. I forgot I had some stuff coming up in here. So we have a T account, looks like a T, of course. And again, the left side is the debits and the right side's credits. Your debits and credits always equal. This is something that I would probably print out and have if you are doing any kind of debits and credits. This is just kind of shows you an overall of each type of transaction. So on an asset, you have your increase is your debit and your decrease is your credit, and you have your liability and owner's equity. Down here, this is going to be your income and losses versus your revenue and income. And again, this kind of shows you how an entry is to be created manually. This is something that a lot of owners don't understand, and sometimes a lot of CPAs have to actually do the T account to understand which side is going to be your debit and which side is going to be your credit. So if you pay a bill, you credit cash, a reduction to cash because it's an asset, and then your debit account's payable as a reduction to your liability account. And we'll be back with more basic accounting.